If you want to completely kill a legacy retail brand, there's actually a very reliable playbook you can follow.
Oh, yeah, a grim little step-by-step guide.
Right. So first, you drown yourself in debt, just massive amounts of it. Second, you train your customers to, never buy a single item unless there's a giant flashing 40% off red sticker on the tag.
The endless promotional treadmill.
Exactly. And third, you run your supply chain and your inventory management like it's, I don't know, 1995.
Which is pretty much exactly what we watched happen to so many mall staples over the last decade.
Yeah, we just watched them slowly surrender to the elements. But today we're looking at a heritage brand that didn't just dodge that bullet. They completely recoded the matrix.
It's really the absolute definition of stripping a struggling business all the way down to the studs, looking at the underlying foundation and realizing you're actually sitting on pure gold.
Welcome to your custom-tailored deep dive. It's Thursday, April 9th, 2026, and today you and I are digging into the newly released Q4 and full year 2025 earnings report from Roots.
A really fascinating report, too.
Yeah, we've got a fantastic stack of sources mapping out this entire turnaround. We're pulling from the official earnings call transcript, the corporate press release, and the Q4 slide deck.
And our mission today is really to uncover how this heritage Canadian apparel brand, a company that literally started in a small Algonquin Park cabin back in, 1973?
Yep, 1973.
Right, how they managed to completely re-engineer their business model. I mean, they've embraced artificial intelligence, they've completely shifted the psychology of their customer base, and because of all that heavy lifting, they're now sitting on what could be a massive acquisition goldmine.
Okay, let's unpack this, because to truly understand the sheer scale of what Roots just pulled off in fiscal 2025, you really have to look back at the financial anchor they were dragging around in 2019.
Good debt load.
Yeah, the debt. Back then, Roots was carrying about $96 million in net debt. And, if you're a retailer operating in a highly volatile consumer environment, $96 million in debt restricts literally everything you do.
You're essentially operating in pure survival mode at that point.
Right. You can't take creative risks when you're just constantly sweating over making the next interest payment.
Exactly. The debt dictates everything. It dictates your inventory choices, your marketing spend, your store expansion plans. It's just a suffocating way to run a consumer brand.
But you fast forward to today's report, and the contrast is just staggering. That net debt has been slashed by 42% year over year.
Wow.
Yeah, they're down to just $4.3 million. And their leverage ratio is sitting at less than 0.2 times their trailing 12-month adjusted EBITDA.
Which is huge.
Yeah.
But we should probably translate that into plain English for a second.
Good call.
So EBITDA is basically a company's raw operating profit before things like, interest and taxes get taken out.
Right.
So a leverage ratio of 0.2 essentially means that for every single dollar of operating profit Roots makes in a year, they only owe 20 cents in debt.
That's crazy.
It is. It's virtually unheard of for a legacy retailer to be that unburdened.
And that sparkling clean balance sheet finally gave management the runway to, actually run the business proactively rather than constantly playing defense.
Right, because if you look at the full year 2025 metrics, their total revenue hit $277.7 million.
Which is a very solid 5.6% increase.
Yeah, but the real headline is the net income. They reached $4.7 million in pure net income for the year.
Which gives you a bit of whiplash when you look at the historical data, considering they posted a $33.4 million net loss the year prior.
A massive swing.
Yeah. But to me, the absolute wildest metric in this entire stack of sources is the gross margin. I mean, this is the number that tells the actual story of the customer.
It really is.
In 2019, their gross margin was 53.4%. And the data show that over 60% of their customers were only buying items when they went on sale.
They were purely bargain hunters holding out for clearance events.
Exactly.
And that's that promotional treadmill we mentioned. Once you condition a shopper to expect a discount, they will flat out refuse to pay retail value.
Right. They know that if they just wait 3 weeks, that exact same sweater will be marked down by 30%.
Exactly. But look at the 2025 numbers. They just posted a record full-year gross margin of 61.3%.
And here is the real kicker. Over 70% of their customers are now buying at full price.
That's incredible.
I want you to think about how incredibly difficult that is to pull off. It's basically the equivalent of a massive discount outlet successfully retraining its bargain hunting customers to suddenly treat it like a premium luxury boutique.
You don't just snap your fingers and change mass consumer psychology overnight.
No, you don't.
What's fascinating here is that a business isn't just what it sells, but how it sells it. Moving away from a promotional, discount-heavy model requires immense, almost painful discipline.
Oh, I can imagine.
Think about it from the perspective of a store manager or an e-commerce director. When sales are slow on a random Tuesday in October, the easiest, most tempting thing in the world is to just blast out a 30% off everything email.
Right, it gives you that immediate sugar rush of revenue to hit your daily quota.
Exactly. But long-term, it completely destroys your brand equity and erodes your product margins.
You know, if you're running a small business or even just managing a team in your own career, there's a massive lesson here about the pain of setting boundaries. Roots essentially had to send its entire customer base to retail detox.
Yeah, they had to willingly watch their daily sales drop for a while.
They had to be comfortable losing the pure bargain shoppers who were never going to pay full price anyway, just to elevate the brand's perceived value for everyone else.
And the sources show that this intense discipline yielded incredible free cash flow. It hit $40.8 million in Q4 alone.
Wow.
Yeah, that is cold, hard cash generated directly from operations. And it only materializes because they held the line on pricing and refused to devalue their own product.
But I mean, you can't just strip away the discounts and expect people to stay out of pure loyalty.
No, definitely not.
If you're suddenly demanding full premium price from your customers, the product actually has to be premium. You have to manufacture heat. You have to give that shopper a compelling reason to pull out their credit card without the artificial incentive of a flash sale.
And that brings us to the merchandising and marketing engine, which clearly shifted into high gear during the fourth quarter. You can see the strategy working perfectly in their specific product wins.
Yeah, they leaned heavily into categories where consumers are currently willing to spend premium dollars.
Right, like the Cloud Fleece collection, which was a massive standout here.
Yeah, the Q4 slide deck notes that the Cloud Fleece line more than doubled in sales year over year. And their activewear category also delivered double-digit growth.
We're seeing a sustained consumer shift there. Premium lounge and activewear aren't just for the gym or the couch anymore.
Right, they're everyday wardrobe staples now, and Roots totally capitalized on that.
But they didn't just rely on their core everyday items either. They strategically utilized brand alignments to manufacture urgency.
Right, because when you collaborate with another massive cultural entity, you're essentially borrowing their relevance for a limited time.
Exactly. And Roots went massive with those collaborations. They secured the Universal Studios Wicked Winter collaboration, which management specifically noted drove significant brand fees and a huge influx of customer engagement.
And they also designed a limited edition capsule collection with the NFL to celebrate the 60th Super Bowl.
Yeah, and then, staying incredibly true to their local heritage, they launched a Toronto Blue Jays collection right in the middle of one of the franchise's most exciting seasons.
And wrapping all of that product strategy together was their Q4 marketing push. They launched the Anything Roots holiday campaign featuring Seth Rogen.
Which is just absolute perfect casting for a Canadian heritage brand.
Oh, totally.
The earnings call highlighted his warmth, his authenticity, and his unmistakable Canadian charm. But what is critical here is how they deployed him.
Right, they didn't just buy a few highway billboards.
No, they blasted this campaign across Netflix, Prime Video, Spotify, and targeted out-of-home ads.
Aye.
By utilizing over-the-top, or OTT media, they weren't just shouting into the void of traditional broadcast television.
They were putting Seth Rogen directly in front of highly targeted demographics on the platforms where modern consumers actually spend their time.
Exactly. They leveraged his specific cultural cachet to make Roots top of mind during the most fiercely competitive gifting season of the year.
Wait, hold on. I'm looking at the Q4 numbers, and there is a pretty glaring contradiction here.
Oh?
Yeah, we just praised them for retraining the customer to pay full price, but management admitted on the earnings call that they actually ran out of the Cloud Fleece.
Like the stockouts.
Yeah, they literally had stockouts in key lifestyle silhouettes. I mean, that's not a win. That is a massive logistical failure right before the holidays. If demand is surging and you don't have the sweaters on the shelf to sell, you just left millions of dollars on the table.
Yeah, you're catching a major friction point in the report there. They absolutely left money on the table in Q4 because consumer demand heavily outpaced their available supply.
Right.
But if we connect this to the bigger picture, a strategic stockout, while frustrating, is infinitely better than a massive overstock that forces you to revert back to discounting just to clear the warehouse.
Okay, that's fair.
And the transcript shows that Roots is actively learning from this friction.
So how do you solve a stock out without over-ordering and ruining the margins you just spent years fixing?
Well, management specifically stated that they are looking at these Q4 stockouts as a prime opportunity to extend the life cycle of their products.
What does that mean in practice?
So retailers traditionally operate in very rigid, archaic seasonal goes. You bring a heavy fleece in for July, and the traditional retail playbook dictates that you pull it from the floor by October to make room for holiday gear.
Right, you cycle it out.
Exactly.
Yeah.
But what Roots realized through this unfulfilled demand is that the life cycle for these specific items is stretching much further. A product meant for a narrow July to October window can actually sell at full price right through April.
Oh, well,
Yeah. So moving into 2026, they are planning to increase the depth of their buys on these specific, proven collections to capture that extended demand without having to introduce brand new, unproven silhouettes.
okay, that makes total sense. It's all about finding the absolute ceiling on full price demand without crashing through the floor into markdown territory.
Exactly.
But none of this product heat and none of this clever marketing magic really matters if you can't physically get the clothes into the customer's hands quickly and efficiently.
100%.
A brand can have the best Seth Rogen ad in the world, but if the back-end operations and the website fail, the revenue simply doesn't materialize.
The logistics and the supply chain are the unsung heroes of literally any retail turnaround.
Mm-hmm.
If the engine room is broken, the ship doesn't move.
And Roots has been quietly, comprehensively overhauling its engine room.
And the Q4 data proves the overhaul's working. I mean, direct-to-consumer, or DTC sales, hit $107 million in the quarter.
Which is a 5.7% increase?
Yep. Comparable sales grew 7.3%. And if you zoom out and look at it on a 2-year stacked basis, comparable sales are up a massive 14.8%.
Which signals to the market that this is not a one-off pandemic fluke or some weird seasonal anomaly. It's sustained momentum.
Right. And they achieved this by drastically improving their retail store conversion. They didn't just open the doors and hope people would buy.
Right. They invested heavily in visual merchandising, so the product looked premium. They trained their sales associates to sell on value rather than price, and they optimized their store hours based on actual foot traffic data.
And then they paired that physical in-store experience with highly targeted paid media, driving traffic straight to their e-commerce platform.
Here's where it gets really interesting, though, because the most radical operational shift in the entire earnings report is what happens after you click buy.
Yes, the Metro deal.
Exactly. The sources highlight a massive announcement from January 2026. Roots signed a new 10-year distribution partnership with Metro Supply Chain.
A massive shift for them.
Yeah, they are shifting their fulfillment from their own in-house company-operated facility over to Metro's tech-enabled hub in Ontario. And they expect to have this transition entirely completed by July 2026. Now, I have to assume handing over the keys to your entire distribution network is a pure cost-cutting play, right? A way to slash payroll and get out of the warehouse management business.
Well, it definitely impacts the balance sheet by reducing fixed overhead, but it is fundamentally about scaling capabilities without massive capital expenditure.
Okay, how so?
Logistics is an incredibly complex, capital-intensive game right now. By partnering with a massive third-party logistics provider like Metro, Roots instantly gains access to cutting-edge supply chain infrastructure that would take them years and tens of millions of dollars to build from scratch.
Right.
It instantly enhances their omni-channel capabilities. Things like buying online and shipping directly from a local store, or returning online orders in person and getting that item back into available inventory instantly. All of that friction disappears when you have a world-class logistics partner handling the routing.
But they aren't just upgrading their physical warehouses. Roots is fully leaning into the AI revolution.
They really are.
We are talking about a heritage brand, born in a cabin with a beaver logo, utilizing absolute cutting-edge technology behind the scenes.
They're deploying artificial intelligence across multiple facets of the business to eliminate human error and streamline costs.
The inventory management alone is wild to read about. They are using AI-driven inventory allocation to fix those exact stockout rates we just talked about.
Right.
Think of this new AI tool like an omniscient, invisible store manager who perfectly predicts exactly which size and color of a Cloud Fleece hoodie needs to be shipped to a specific retail store in downtown Toronto versus a suburban store in Vancouver before the customer even walks through the door.
It analyzes local weather, past purchasing behavior, and demographic trends to put the right shirt in the right city.
And that invisible manager never sleeps, and it never makes a math error.
Exactly. And they're also using AI to automate large portions of their customer service, which directly reduces call center costs and protects that hard-earned bottom line.
Yeah.
But the most forward-looking, fascinating application they discussed on the earnings call is optimizing their digital infrastructure for agentic AI.
Agentic AI. That sounds like something straight out of a sci-fi novel. Let's break down the actual mechanism here. How does a clothing brand optimize for an AI agent?
So, traditional e-commerce optimization, or SEO, is built for humans using Google, right? You use keywords, so a human finds your website, clicks, browses, and eventually buys.
Right.
Agentic AI refers to artificial intelligence agents, essentially bots powered by large language models that don't just answer your questions, but actually take action on your behalf. Imagine you tell your personal AI assistant, find me a high-quality, comfortable green fleece hoodie for under $100, make sure it's in stock in a size medium, and just buy it for me.
And it just goes and does it.
Exactly. Roots is actively optimizing their site's underlying code, using structured data and highly specific schema markup, so that when an AI bot goes out crawling the web to shop for its human, it can instantly read the fabric weight, the sizing availability, and the shipping speed.
Wow.
By making their data perfectly machine-readable, Roots ensures the bot chooses their hoodie over a competitor's.
That is mind-blowing. They are literally formatting their digital storefront, not just for human eyes, but for robot personal shoppers who are executing transactions at lightning speed.
It is an entirely new frontier of retail discovery.
Yeah.
If your website code is messy, the AI agent simply skips you. Roots is ensuring they are highly visible in that emerging landscape.
But of course, no earnings report is entirely sunshine and rainbows.
No, never.
Every business faces friction, and building out these AI tools and massive marketing campaigns is not cheap. So let's pivot to the reality check. Let's look at the headwinds in this report and, frankly, the massive corporate elephant in the room regarding the company's ultimate future.
Right. The costs of this massive transformation are highly visible in the Q4 data. Selling, general, and administrative expenses, what the financial world calls SG&A, which is basically the day-to-day overhead of running the business, that jumped 9.1% in Q4 to $49.3 million.
And we need to break down exactly what is inside that $49.3 million because it's not frivolous executive spending.
No, not at all.
$2.8 million of that jump was the elevated marketing we just discussed, the massive OTT media buys for the Seth Rogen campaign.
Right.
They also absorbed higher personnel costs to train those retail employees, but there was also a very specific $1.1 million hit from unexpected U.S. duties.
This is a crucial macroeconomic detail that really shows how vulnerable retailers are to government policy.
Yeah.
The U.S. recently eliminated the duty-free de minimis exemption on e-commerce sales.
What did that exemption do previously?
Previously, international shipments under a certain dollar value could enter the United States without being subjected to import taxes. It was a massive loophole for cross-border e-commerce.
Ah, I see.
With that exemption gone, Roots suddenly had to absorb an extra $1.1 million in duties just to maintain the pricing on their U.S. e-commerce business. It is a direct hit to their expense line, caused entirely by a shift in international trade policy.
Got it. There was also another slightly glaring red number in the report that we need to contextualize. Partner and other sales were actually down 11.5% in Q4.
Yeah, that looks bad on paper.
Right. If you just read the headline, it looks like their wholesale business is suddenly collapsing.
But the earnings transcript explicitly explains the mechanics of why this happened. Their international operating partner in Taiwan simply took their holiday and spring wholesale shipments early. Yeah, they took the physical delivery of the goods back in Q3 instead of Q4. So the revenue didn't disappear. The transaction just shifted quarters on the calendar. The underlying demand in Asia remains perfectly intact.
Okay, so when you roll it all up, the core business is remarkably solid. The balance sheet is clean. They've eradicated the discount culture. The margins are at record highs. The AI and supply chain engines are fully revved up,
Yep, firing on all cylinders.
which makes the massive corporate announcement from March 3rd, 2026 so incredibly jarring.
The strategic review.
Yes. Just weeks before this earnings call, the board of directors announced they have initiated a formal review of strategic alternatives to maximize shareholder value.
Right.
And during the earnings call, CEO Megan Roach firmly refused to provide any details. She wouldn't take a single question from analysts on the topic, leaving the outcome and the timing a total mystery to the market. So what does this all mean?
Yeah.
I mean, when a company that just successfully completed a grueling multi-year turnaround announces a strategic review, what are we actually watching unfold?
This raises an important question. Because strategic alternatives is classic Wall Street corporate speak that almost universally translates to, "We are hanging a for sale sign on the front door."
Right.
It could mean a full sale of the company to a private equity firm that wants to squeeze out even more margin. It could mean an acquisition by a much larger retail conglomerate. Or it could mean taking the public company private to escape the quarterly scrutiny of the stock market.
But the timing feels so counterintuitive. Why endure all this grueling work to fix the margins, lower the debt, and retrain your customers just to hand the keys over to someone else the minute the business gets healthy?
Because that is the exact moment you command the absolute highest valuation.
Ah.
You don't list a house for sale when the roof is caving in and the basement is flooded.
Oh.
You list it right after you've completed a stunning top-to-bottom renovation.
That makes perfect sense.
Roots has proven their new model works. They have proven they can command premium pricing. They have a pristine balance sheet. To a potential buyer, the operational risk has been entirely de-risked. They are selling a turnkey profit engine.
But you also have this incredible, palpable tension happening inside the C-suite right now.
Oh, absolutely.
On one hand, the board is exploring a sale. On the other hand, management is acting like a company meticulously planning for the next decade. They literally just signed a 10-year supply chain deal with Metro.
Yeah.
And in February 2026, they appointed a brand new chief commercial officer, Rosie Puzar, who came over after a massive, highly successful run as the chief operating officer at Sephora Canada. You don't aggressively recruit top-tier executive talent and sign decade-long logistics leases if you are just planning to cash out and walk away tomorrow.
And that is the brutal tightrope management has to walk during a strategic review. You have to operate the business with absolute conviction for long-term growth, because if a potential sale falls through or the macroeconomic environment sours, you still have to run the company on Monday morning.
You can't just pause the business.
Exactly. You cannot let the operational momentum stall while investment bankers sit in a boardroom looking at spreadsheets.
Which brings us to the core lessons that you, the listener, can pull from this deep dive, whether you are managing your own career, evaluating an investment portfolio, or running a business. Roots is definitive proof that pricing discipline, the sheer willpower to refuse the easy sugar high of discounting, is the bedrock of profitability.
Absolutely. When you pair that unwavering discipline with authentic heritage storytelling and then overlay it with modern, hyper-efficient AI infrastructure, you can fundamentally resurrect a brand's bottom line. You can, in fact, retrain your customer.
It is an incredible story of contrasts, and it leaves me with one final lingering thought based on everything we've analyzed today.
What's that?
We talked at length about e-commerce shifting toward this agentic AI model, where bots and algorithms are literally parsing schema markup to do the shopping for us.
Right, the invisible, lightning-fast personal shoppers.
But how does a brand rely on deeply emotional, distinctly human concepts like heritage, nature, and nostalgia when they are marketing to lines of code?
That is the big question.
I mean, can the rugged aesthetic of a 1973 Canadian cabin actually charm an AI shopping bot? Or is the future of retail strictly a cold, calculated game of optimizing data feeds and technical fabric specs?
It is the ultimate collision of the campfire and the supercomputer. We're going to find out very soon which one drives the algorithm.
We really are. Like we said at the start, legacy retail isn't always a teardown. Sometimes it's a total rebuild, right down to the studs. Thank you for joining us on this deep dive. We will be right here, ready to be your personal guides through the next stack of sources whenever you're ready to learn something new.